Mehul for those very sweet words. Hinesh Doshi and all my other friends of the IGF, Chamber of Tax Consultant, Forum of Free Enterprise, and above all, Matuba Gymkhana, under whose auspices we all have been physically meeting for a number of years. Past 2 years, COVID has made us participate through this online discussion. So, coming to whatever little I have to say, and that too largely in the past, I have been covering the direct taxes part. However, uh, as you all know, this year also the finance minister has surprised us by making no change at all in the direct tax rates. This is the third year in succession where no change has been made. Now, therefore, they say this is no news, and no news is always good news. Uh, However, I can tell you the best part of the news is going to be in the budget of 2023. And we may see a across the board reduction in direct taxes. How do I say this? I say this based on today's Times of India, which carries the interview with the chairman CBDT, in which he very clearly says that we believe that when a bureaucrat at that senior level says, he is saying it with full responsibility, even of the political bosses. Therefore, what does he say? He says, we were very keen that various tax exemptions and reliefs should be done away with and substituted with lower rate of tax. And this virtually would coincide next year in good time for the general elections of 2024. Relief to all sections is bound to be a very populist measure. And I'll not be surprised that there will be reduction also in the GST rates applicable to items of mass consumption. Therefore, you please everybody in right good time. Now, there are several positives in this budget. All experts have expressed their opinion, and they are virtually unanimous in their praise for all the wonderful things that this budget has attempted to do. Few of them we will consider. One of the most outstanding features of this budget is providing for huge spending on infrastructure, 7 lakh crores, and that too by government as well as by the private sector. We all know that infrastructure means roads, airports, and the bridges. And you can't think of these infrastructure items without thinking of steel, cement, and all other ancillary items that go into an infrastructure project. This has also spending by government as well as by private sector on such a huge scale, 7 lakh crores, will obviously have a multiplier effect. The finance minister has repeatedly mentioned about the multiplier effect. And this is true. Yesterday, Chairman Hindustan Lever, he mentioned that his company observed that wherever there were new roads coming up, the villages around those roads experienced huge prosperity and therefore huge rise in the consumption of Hindustan Lever Company's products. The post-COVID has resulted, all of us, though we all know the third wave has not finally gone, but it's almost on its last legs. Let's hope, let's pray that there is huge buoyancy in the direct tax collections as well as in the indirect tax collections. Now, this indicates fairly good signal for revival of the Indian economy. The effect of all this we have to see to believe at all the holiday resorts. You go anywhere and everything is booked, whether it is Kandala, Lonavala, or Masuri, Shimla, wherever. So the point is there is a rebound effect of spending by the people. And this has resulted in huge buoyancy in GST, and also because of the huge corporate profits, there is huge corporate tax collections. Now, this is a very welcome sign. There is a conscious shift in the spending and giving incentives to sunrise industries from the sunset industries. Therefore, you find substantial tax benefits for digital industry, for fintech companies, and therefore this will also have a very high multiplier effect of prosperity. Deliberate effort to prefer growth over inflation. Finance Minister was at pains to explain that why she chose growth, even though she says, I'm conscious that it could result in some marginal rise in inflation. But she said we felt that rise in the growth in the industry is preferable over marginal increase in inflation. That's also a factor which has led to India being the preferred emerging market economy. Huge inflow of funds from overseas is witnessing. Global liquidity is all-time high, and major part of the global economy liquidity is coming to India. India, as I said, is outperforming among the emerging economies. Two few negatives which can spoil the India party, and that is one, the results of the UP elections. We are aware that if something goes wrong there as far as the present government is concerned, we will have a different scenario. The second could be spoiling the party is the Ukraine war, the India, the US and the Russia and the NATO and what have you. The third is on a minor scale, the UAE and Yemen. So these factors could disturb the otherwise wonderful journey, wonderful party that we can look forward. And that party will be celebrated by two of our celebrated speakers for today, Mehraboon and Jimeet. Both are stalwarts in the capital market, equity markets, and they are beaming from year to year. The reason being that the index is going up and the economy is doing very well. So with these few words, thank you very much, friends. It was a pleasure talking second time online under this wonderful auspices. Thank you very much.
So I think as far as I will share one part of a capital market view in terms of what we think of how the market has received the budget. And I think we always sum up the budget with one key thought. And this year, I think the fact is that no bad news is good news. I think that is the key driving fact from a budget point of view. And the reason why we specifically say that no bad news is good news is because we are very close to elections in a very, very key state. And there was a lot of expectation, a lot of worry in the market, that there could be certain populist measures. In fact, myself for once was expecting, a significantly large increase in Manrega allocations and some other socialist measures, which would be more on the revenue expenditure side rather than being on the capital expenditure side. But I think the government has decided to be prudent in that way, and there has been no bad news in the markets, and which is why we've seen that past couple of days the markets were fairly buoyant. And while there was some correction today, but I think otherwise they were buoyant. So the market reaction was not very violent. Now, in terms of the budget specific, I think what we've done is just to sort of segregate what's good in the budget and what's bad. First of all, I think on the good side, the market has appreciated that there is a lot of fiscal prudence. So, she has come down to a sub 6.4% kind of a fiscal deficit for next year as a target. Plus, there has been all the numbers that have been accounted for in the budget are fairly prudent. Even in fact, for that matter, they've recognized that disinvestment every year they keep missing the target. So this year they've in fact lowered the target as well. So it's a fairly honest and transparent budget, very, very prudent. Secondly, as Kanubhai said, the capital expenditure focus of increasing capex to 7.5 lakh crores was a big boost, and as everybody has been rightly saying, there's a big multiplier effect there. It keeps happening. I think the market, essentially what market wants to see always is that there is no problem with money being spent as long as money is being spent for creating further growth and further investment and building assets rather than merely a revenue expenditure. So to that extent, I think the market has given a big round of applause. I think MSME startup focus has been critical, is something that is good has happened in the budget. The infra focus, even digital push for that matter, the entire push on the on the fintech space, continued focus on digital payments, in introduction of a digital currency by RBI itself. Now these are all the good things that have happened and have been announced in the budget. So it's a very investment oriented focused budget. Now, as far as what there are certain sections of the market, including us, what we did not like. I think this is a very supply side oriented budget. I think a lot of the focus of the government has been on fixing the supply side of the market, building infrastructure, doing capital expenditure, a lot of investment. So I think two of the largest segments where investment is being made are roads and railways. So a lot of supply side investment is being made, but very little has been done to sort of stimulate demand. And that is typically a slight negative. There was a lot of expectation of a housing sector boost, so which could either have come from certain standard deductions for EMIs, etc., or interest payments. There was a discussion that the limits from the current 2 odd lakh rupees could go up. Even ATC limits could go up, but none of that has actually happened. And I mean, maybe as Kanubhai said, we could be in for a surprise next year. And finally, there is very little focus as far as moderation of taxes is concerned. I think still there was a little bit of talk about how the surcharges and for certain segments of the investors as well as taxpayers, the tax was excessively high and there was some moderation expected, but that's not happened. So I think broadly, this is what is split in terms of what's good in the budget and vis-a-vis what is bad in the budget. Now, in terms of what should we do in the capital market? So see, fact is that the budget got discounted on the day of the budget itself. So we live in a nearly perfect world as far as information is concerned. There is no markets typically end up discounting events as large as the budget in less than a few hours, if not minutes. So the market impact of the budget itself was in our view discounted on the first itself. And then after that, now we have moved to sort of other forward-looking events and tracking the global market. So now my emphasis for the rest of my talk is going to be as to what we should do in the capital markets, what is our view and where we believe we seem to be going. And our broad view is that I think the Nifty is in a corrective mode. I think we've had a fabulous rally over the past few years. I put up the chart of the Nifty for the past 8-9 months or so. And if you see, we nearly had a one-way run up. And starting November, we've started to see some resistance at the 18,400, 18,500 levels. The market fell a little bit, corrected towards the end of December. On December 20th, it bottomed out, went back up again to 18,400 levels pre-budget, then again started falling again before the Fed's meeting last week. So broadly, we are now entering a correction mode is our view. We are in a correction. Now, there are two things that could happen in a correction. Either we could have a long sideways correction where the markets actually don't end up doing anything for a really long period of time. Or we could have a very swift, sharp correction, and then we could start moving back up. So I think both the options are open. We don't know what's going to happen, whether it's going to be a time correction or a price correction. In fact, in certain segments of the market, the correction has been very, very brutal. So, while the Nifty is down barely, 6 to 7% from the top, there are certain stocks which are down, in fact, 20, 25%, even 30% and more, as far as the markets are concerned. And if you see the last leg of the up move, which has just happened pre-budget, with that you will see somewhere here, it has happened. I think the PSU banks, several set of PSUs, value businesses, cyclicals have led this up move. In fact, PSU banks have far outperformed private sector banks, and I think part of it is also sentimental because of the fact that the LIC IPO is coming in. So I would not call this last leg of up move as a very, very healthy up move, because typically what happens in a true healthy up move is that leaders or market leaders which contribute to a large proportion of the indices, they end up leading the markets and taking the markets up. In fact, at the moment we are seeing that the weakest segment of the market, which has historically been the weakest, that is what is trying to pull the market up. And when you typically rely on the weakest names to go up, to that extent, you're always going to run out of legs at some or the other point of time. So, there is resistance, there is correction that we anticipate. Now, in terms of, our belief as to why there are excesses that need to get corrected, I think there are certain segments, certain pockets of the market where there have been excessive challenges, really. So, we are seeing a record number of demat accounts being opened in the past 6 months. We have seen record amount of retail participation. We run a fairly large broking setup, and we have seen tremendous traction on that side. Even in fact, for the LIC IPO, a lot of emphasis is being put on policyholders to open demat accounts. And my sense is that between February and March, we will see a record number of demat accounts being opened and new participants coming in. But usually this is always a sign of worry. I think the last time there was such a rush for extreme number of demat accounts to be opened was during the Reliance Power IPO in 2008 January, where when the IPO came, I know brokerages which were opening 4,000-5,000 accounts a month opened 50,000-60,000 accounts a month, and those accounts over a period of time ended up losing money and became dormant. So this is one sign of worry that we see. We've seen in the past 4 to 6 months, penny stocks, 2 rupee stocks have multiplied in value, gone to 8-10 rupees. A lot of story-based stocks have actually risen astronomically without any fundamentals, etc. And that is also a cause of worry. In fact, in certain businesses we have seen, we observe shareholding patterns. For absolute shell companies, bogus companies, the number of shareholders of their companies has gone up from 500 to 10,000, 20,000. So, that's a real sign of worry that there is such euphoria in the market, especially in the retail investor segment. The third is we've seen that new age tech startups in India, there is a rush. Everybody has started to believe that, unless we IPO right now, we will not be able to sort of get an exit. And we are seeing that excess getting corrected. So we've seen Paytm getting corrected significantly. We've seen Nykaa getting corrected. And I think that we've in fact even seen Zomato, which actually did well on listing, even that is getting corrected. So I think that, but the reality is that when you see these kind of stocks, when they start a correction, they don't stop at 20, 30, 40%. We've seen that during the dot-com bubble. Excessively valued stocks can actually even end up going down 70 to 80% from their all-time highs. So, we would not be surprised if that was to happen. One more worry that we end up seeing is that, in the derivatives market, which is the F&O market really, if you see the positioning of the market, it is the retail investors that are actually long, and the foreign institutional investors, which are probably considered to be slightly more stronger hands. They are short, net short as far as the leading indices and the stock futures are concerned. So again, that's a little bit of a worry for us. What we are also seeing is that stocks in the past few weeks have actually fallen despite of good news. So Bajaj Finance reported a blockbuster set of earnings. But despite of that, it has been down and has been correcting since then. Even Airtel, for that matter, there was a phenomenal news of Google buying in and investing about $1 billion in Airtel, but still, the stock still end up corrected and is not even reached the price at which Google did. So if we were in a roaring bull market, we would have actually seen these stocks react to these positive news very, very positively and with sharp up moves. But in fact, we are seeing distribution as far as the markets are concerned at the moment, and which is not a very, very encouraging sign. And I think one of the biggest sentiment checkers for me is that, in this market fall that has happened recently in the past, prior to the budget, I've not got a single call asking me we should sell. Typically, people have only called me and asked me how much more money should I put in. People are waiting on the sidelines. People are waiting that okay, thoda correction aa jayega to button daba ke paisa dal denge, and which again means that we are not nowhere close to sort of the end of the correction, because there is not even the slightest hint of panic from a retail investor point of view, and which is why we believe that finally, I think our sense is that we've seen Jan highs at 18,400 odd levels. That was a January 22 high for the Nifty, and our sense is that we expect a 10 to 15% drawdown from those levels at least. So that would typically mean that we are expecting the markets to go to anywhere between sort of 15,800 levels to 15,500 levels. The correction could further be deepening, but yeah, I think that is a certain level of drawdown that we do expect that could happen, that investors should be prepared for. Though, and markets falling by 10-15% is no big deal. They end up falling at such a pace with a large frequency. So I think investors should be prepared for that kind of drawdown. We should not expect that the markets are not going to fall below 17,000 or 16,500. I think we should be prepared for slightly deeper cuts and corrections from that point of view. And one of the other reasons why we believe this is that if you see, the structure of the Indian market is also very similar to the structure of the US market. So this is the S&P 500, and even in the S&P 500, you'll see a very similar pattern where it sort of created a top in the first few weeks of January, then fell, and then after the Fed comments has slightly come back up and bounced back. But again, we are continuing to see a set of correction be happening there as well. And in as far as the Nasdaq and certain other segments of the US markets are concerned, there has been a very, very deep correction. In fact, almost 50% plus of the Nasdaq stocks are significantly below their long-term moving averages, which implies that the markets are in a very, very serious correction, and this correction is not going to get over very, very quickly. So we are going to see some amount of time correction that will also happen, and if the US corrects, I don't think India is going to sort of decouple itself completely. We will also have a similar kind of correction. And a lot of people ask us as to why this is sort of typically happening. And I think one of the biggest reasons as to why this is happening is not our budget or anything else. It is the fact that now interest rates are very, very clearly moving up. I think the Fed has guided that inflation is now above the comfort level that they have. They have passed hawkish statements in the last meeting. And what ends up happening is that if there is rising interest rates, typically there is a repricing of assets that happens. So just to give you a little bit of an example as to how investors, normal investors like you and me, should think about this. Think about fixed deposits, right? So when you invested in fixed deposits about 3 years ago, you used to get an interest rate of about 7 to 8% on a pre-tax basis. So typically you are getting 8 rupees for a 100 rupee investment. On a price to earnings multiple, you are getting a multiple of 12 times odd on a normal fixed deposit. Now, in today's times, the fixed deposit rates, as we all are aware, has gone to sub 5%, which means that for every 100 rupees that we are investing, we are getting 5 rupees in earnings. So the multiples of fixed deposits have moved from 12.5 to 20. So we have seen almost a nearly 60-70% expansion in the multiples of fixed deposits. And similar thing also happened with the Nifty. So Nifty's median price to earnings multiple is 16.5, 17. In the past few months and last couple of years, because of a very low interest rate regime, the multiple of the Nifty has also expanded from the 16-17 median to currently about 24-25. So by no means are we cheap from a market point of view. And what ends up happening is that if interest rates go up again, and interest rate starts moving from, let's say, 5 to 6%. Now, if interest rates even move by 1%, the multiple of the fixed deposits will fall from 20 to 16.5. So if you get 6 rupees for 100 rupees, your multiple typically is 16.67, which means that there is a 20% correction in the multiples. Now, if such a similar correction was to happen in Indian equities, and that's also happening in global equities, if our multiples were to compress from 24 to 21, 22 kind of levels, which is easily possible, it is not a far-fetched reality, then that would simply mean that even if earnings sort of offset this multiple decompression, we would still be looking at a 15-16% repricing of assets. So a 15-16% correction cannot sort of be ruled out. Our sense is that Indian markets are buoyant. They will sort of hold up till the LIC IPO. And typically we have seen that a very, very large IPO of, which sort of sets records of sorts always is what sort of punctures or creates a short-term euphoria in the market. And LIC, as we all know, is going to be a very large IPO. It's going to be anywhere between 65,000 to 75,000 crores. It's going to smash all records from an IPO perspective as far as mobilization, number of investors participating, etc., etc. So I think the government will do everything in its power to make sure that the market stays steady till the LIC IPO is completed. But after the LIC IPO, so typically March historically has been seasonally the toughest months for the market. And March is when the LIC's IPO is stated to happen. And if the IPO happens, it sucks out 65 to 75,000 crores of liquidity. That liquidity that will get sucked out from the system will start causing pressure on the rest of the market. So that is typically what we see. Investors over the past year and a half have seen phenomenal returns. We've seen returns of anywhere between 40 to 100% on some of the stocks that we own, in certain cases, even 200-400%. So it's been a wonderful bull market for all of us, but we should brace for volatility. We should brace for the fact that there could be a 15 to 20% correction that could happen anytime over the next few months. So finally, I think in terms of investment strategy, that is the moot point, right? What should we do from an investment strategy point of view? There are three things, and I think our sense is that this is probably one of the last set of time opportunities to switch from poor quality stocks to good quality stocks. So there are stocks where people, I've seen very, very poor quality stocks where fundamentals are extremely poor, move from even 15-20 rupees to 95-100 rupees. 3-4 rupees stocks have become 10-12 rupees. And so these kind of stocks are giving one opportunity to set of investors to sort of make an exit and move to better quality stocks. So because if at all when the correction happens, what's going to happen is that better quality is going to obviously correct, but it will correct by a smaller margin as compared to poor quality. I think poor quality stocks in a market correction could fall anywhere between 50, 60, 70%. As far as second, I think our view is that you stagger investments via either the STP route or an SIP route. Whether you do it in a mutual fund or via direct equity is your call, depending on how you invest. But I think idea is that you should stagger your investments over the next few months. And finally, I think keep your shopping list ready. So I think the story from an India perspective, from a global perspective, is still very, very strong. We are nowhere going into a bear market. I'm not bearish by any means. I'm just saying that there is a healthy correction that needs to happen to correct some excessive euphoria. And in this correction, we should keep our shopping list ready. Make a list of 15, 20, 25 stocks, or maybe 3 to 4, 5 mutual funds that you want to invest in, which are great secular trends to play. And once you have sort of made that list, you put in a certain price range that where you typically like to buy those businesses. And once if you start seeing those kind of price levels, start allocating capital. So I think that is one thing that you should do. And I think from our perspective, what our view from a focus sector point of view, what are the few long-term trends that we are playing, as an investment services house. So first is, I think, technology. We are extremely bullish on technology as a whole segment. So whether it is digital services, digital businesses, and what we have seen always in the past is that, trends that get triggered because of an event, they further get accelerated over a period of time. So digitization, adoption of technology has been a trend that has picked up significantly after COVID. And we believe that this trend is going to only further accelerate over the next few years. So there's a massive opportunity in a variety of technology businesses over the next 8 to 10 years. I think tech easily can compound at between 20 to 24%, 20 to 25% over the next few years. I think the second theme that we really like is the theme of playing financialization of savings. I think that is a beautiful opportunity for investors to play out. So, you could look at sectors like insurance plays, life, general, asset management companies, platform companies like registrar and transfer agents, so on and so forth. These are all great plays on the theme of financialization of savings, where more and more money is moving from physical assets like real estate, gold, into more financial assets, and that is a trend that we can play. And then finally, I think consumer and consumer discretionary. I think there is a great manufacturing story that the government is focusing on as a part of this budget. But our sense is that the best way to play that is through consumption and consumer discretionary names, because these are businesses that have a high return on capital employed. Their ability to make money is much higher as the multiplier effect kicks in. We are not particularly bullish on companies which overly rely on the government for making money. So, it doesn't excite us that you have a company which will probably make some additional money because of the PLI scheme of the government, because we are not looking at one-time lotteries businesses. Typically, we want our businesses, the kind of businesses that we look at, the kind of sectors, to have secular plays that can consistently compound in value over a fairly long period of time. And if infrastructure spends happen, road spends happen, as Kanubai said, and as the HUL chairman said, they also end up seeing a boost in demand, volume growth, and price growth. In fact, they have the pricing power to also pass on price hikes in an inflationary environment. So you look at those plays which have pricing power, which could benefit from widespread consumption increases, both either urban as well as rural, and make a play on that. Even on the consumer discretionary space, you could look at plays which are indirect plays on manufacturing rather than direct plays. So these are some sectors that we are aggressively looking at from an investment services house point of view. And this is broadly how we think about the markets over the next few months. So that's it from me. And thank you so much.
This year's budget, let me state that I am fortunate that I'm not a chartered accountant by profession. I had an option, and in fact, I was wondering whether I should become a chartered accountant or I should go for my MBA. And ultimately, I opted for going for an MBA degree, because if I were a chartered accountant, agar main chartered accountant bana hota, and if the chamber would have invited me to address on this year's budget, I promise you my speech would have been over in just 2 minutes, because there is just nothing as far as tax proposals go in this year's budget. So I cannot envy any person who comes and discusses tax proposals in this budget. My friend Kanu cut his speech short. He has been a wonderful orator over the years. He has taught me taxation in my early days in life, and I'm really grateful to him for making me understand the subject quite well. Now let's come to the union budget before I come to the impact on the stock market, which my friend Jimeet has already covered from his side, his view. I would say that we should first of all understand the backdrop of the union budget, backdrop under which Ms. Nirmala Sethuraman presented this budget. Kanubai spoke of populism, elections coming, and rightly so. I think everybody all sections of the media, Twitter, everybody was speculating कि long-term capital gains tax पे ये होगा, wealth tax आएगा, populism हो जाएगा, उत्तर प्रदेश में schemes आएंगे, ultimately election जीतना है, so there will be a lot of populist measures, and the media also jumped onto the bandwagon and started speculating a lot of things. Housing को infrastructure status दे देगा, excise duty on fuel will come down, and I think they all go away, they escape virtually without anybody questioning them when nothing of this type happens. So it's become a complete speculating type of thing, this should happen, or this will come, or this will come, take care. And we all saw how volatile the markets was before the budget, except for maybe the last 1 or 2 days where some long positions got created. The markets largely came down in the month of January 2022 after a decent beginning for the month. Now let's look at the backdrop. And these are very important points. In this half an hour presentation, hopefully, I think the last 10 minutes, I'll be covering exclusively the stock market, my personal view. At the outset, I wish to state that I am now an investor all by myself, and if I mention in passing any stocks, they are not recommendations. They are done with a good intent that hopefully anybody who acts on that will end up making money, hopefully in the longer term. They are quality companies, and I'm quite sure they should end up doing well over a period of time. So they are all mentioned in good faith, and please rest assured that most of the stocks which I'm going to recommend would be in my personal portfolio or my family's portfolio. So use your own discretion if you wish to act on any stock which I end up suggesting impromptu. The backdrop is that inflation. Inflation is possibly the biggest poison for the stock market. And we saw inflation going up. The US Fed possibly became the real big joker when they went on saying it's transitional. So they became behind the curve. At last, they accepted the fact that it's not transitional. The inflation is a very sticky issue, and it's possibly here to stay for quite some long time. Second is the excess liquidity, which was pumped in. US Fed ne paisa dala, wo paisa mufat mein mil raha hai. People went and invested this money virtually across risky assets, India included, most markets. So money came in a big way. Now there are talks of tapering. By March or April, they will finish the tapering process. Money will go back into the US. FIs started selling. Again, people started speculating, or kitna FI bechega, or kitna FI bechega. But that is a part of life. And I'm not seeing it honestly for the first time in my life. Third is the geopolitical problems. Ukraine, Russia. What will happen? What will US do? Will it lead to a full-fledged war? If Ukraine, Russia happens, what? Maybe China will also time it properly to possibly take care of Taiwan. So all this type of things also are circulating. Quite a few of them are things which actually can happen. This is a concern, certainly, yes. Then there have been global supply challenges. Now, global supply challenges, we all know that because of whatever has happened near the US as far as seawater goes, I think the global supply challenges have happened. That is also a cause of inflation. And the regulation of crypto and other similar assets which happened, I think, especially in other markets, was also a factor which we should consider. Now, what about India? India, there have been a successful launch of PLI schemes in many sectors, full marks to the government for that. Then there have been strong steps towards privatization and disinvestment. And here I'm referring to Air India. Not many had thought, certainly I had not thought, that Air India will be off the government's shoulder so soon and so amicably, because let's not forget, Air India has got one of the strongest trade unions also, and LIC. LIC, we have been hearing for quite some time. At last, action started happening. As a distinct possibility that before the end of March 2022, the public issue of LIC will be behind us. Tremendous fundraising by startups and through IPOs. Now, as startups, I think the figure through private placement has already touched, according to the survey, is 3.6 lakh crores in 2021-22 through around 850 issues. As far as public issues goes, there were about a lakh of crore has been collected, raised by nearly 80 IPOs this year. So in this backdrop, you had the budget coming. Then there was speculation, which honestly, I have never taken sides. I don't have a view when somebody tells me as a whole, hona chahiye, government will support the market, this people will be asked to support the market. Well, I think this used to happen in my days in 1990s, where Unit Trust of India was a big player, and Unit Trust of India came and supported the market, and FIs came. But I personally believe today everybody is an opportunist. To state that the market will be supported for LIC is something which I will not buy into. But yes, the market believes, large part of the market believes that markets will do well till the time the LIC IPO is behind us. Now, coming to the other part, which I would like to state is the budget's clear emphasis on expanding capital. That is capital expenditure. It is a welcome directional change, particularly since a large portion of nearly 45.2% of fiscal deficit is directed to capital expenditure. So out of the total fiscal deficit projected, 45.2% is towards capital expenditure. Is it welcome? Certainly, yes. I think a budget can be termed as a capex carnival. Some people have termed this as the government is betting big on public infra. Some people have said it's re-energizing the infra sector. Some people are saying it's a capitalist budget. Those are the critics are saying. A former finance minister has stated that. Then some people are saying it's an eye on the future. This is what India will be 10, 15 years down the line because of what the government is planning to do now. Changing the scale of India's economy is what somebody else has mentioned. And I fully feel that most of the headings are perfect because contrary to expectations, thanks to populist measures expected, the part that 45.2% of fiscal deficit is directed towards capital expenditure is honestly, from the stock market angle, it's a very big positive. But as far as this capex goes and what it will do to the stock markets and capital goods sector, I think I will touch upon it a little bit later. Now let's come to the main policy announcements. The main policy announcements is that there is a complete commitment as far as the capex goes. There's a focus on infra with National Infra Pipeline and Gati Shakti Master Planning. It continues. These two announcements. There's a focus on sunrise sectors and the digital economy, which I think clear indicators are there that this is going to possibly pick up more and more strength and pace. The data centers have been accorded infrastructure status. They are eligible for incentives and credit available. Government has committed, at least in the budget document, that the 5G auction will happen in FY23 and the PLI for 5G technology manufacturing ecosystem will also be developed. Now coming to the main policy announcements, which I already mentioned some of them. Additionally, the digital currency will be launched by the RBI. No timeline, but it's going to be launched in 2022-23. Could it be a game changer? It certainly could be. Government's contribution for R&D for sunrise sectors should continue. She has laid trust on that. The PLI for manufacture of solar panels has been increased by 19,500 crores. Here, while companies in solar panels, and there are not too many listed companies, if you ask me, I think the stocks would do well, but this is my personal view. I'm not an old man. I'm not becoming senile in any way, but certainly I'm not a critic also. But I would like to state that here somewhere, India has missed the bus. I think China, as far as solar panels goes, is very, 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 very much ahead of what we could end up over the next 2-3 years. I think the big charge up is for the EV industry. Battery swapping policy should reduce cost of ownership and ease of buying. And I personally believe the traction in the 2-wheeler and 3-wheeler segment should happen sooner than expected. Focus on digital platforms in infrastructure, in agriculture, in education. She has laid trust on, and we also know that The digital is something which is a pet of our Prime Minister also. Now we come to the tax provisions. Now I have already mentioned that there are not too many tax provisions, but let me state some of them, which I think they are trying to possibly plug the loopholes which have been existing for quite some time. But before I come to tax provisions, I would like to state that while there have been no change in slab rates, no change in standard deduction, no increase in deduction for interest on housing loans, I would like to spend, I know that this ultimately gets recorded and hopefully it comes on YouTube, and I would like to send this message across to this government. While you all are doing too many good things for the economy in general, for the nation in particular, why do we ignore the middle class so badly? Why do we ignore the senior citizens so badly? We have had 2 years of COVID. At least 90% of the population of this country are disturbed. Quite a few of them lost their jobs. Most of them are at the same level where they were Most of them are at the same level where they were in 2020. Increments have not happened. There have been employees who have lost jobs in stressed sectors, especially sectors like hospitality and travel. Here, your senior citizens who are earning 9 to 10% interest on their bank deposits. And allow me to state, we only talk of stock market. There is a large section of the population of this country who doesn't believe in the market because they don't have an appetite for the volatility. You tell them to invest in mutual funds, they will not be comfortable if the markets come down because the tap as far as money goes has closed. There is no money flowing. All the money they have worked hard for 30, 40 years in their life, they have invested in bank fixed deposits. Now, banks were giving them 9% interest. Banks are giving them 4.5% interest. The income has fallen by 50%. Yet they are paying the same level of taxes. And we are made to believe by the finance minister that we should feel grateful that the tax rates have not been hiked. This, I personally believe, was quite a rude shocker in one of the interviews it was mentioned. In otherwise, a very good job. Here you have a 70, 75-year-old man going to his chartered accountant, either hiring a cab or auto rickshaw and going and filing his returns. Then he's asked for some more documents. He goes back and then he says, I'm paying the same level of tax, but my income has come down, more or less. The percentage is the same. Why can't the government be generous to completely exempt interest on bank deposits from taxation for people above 65 years of age? I am not a chartered accountant, but I am addressing the Institute of Chartered Accountants. I am addressing the Chamber of Tax Advisors. I think why this thing is not getting passed on. According to me, the amount will be trivial. It will not affect the exchequer in any possible way, especially when otherwise we are so generous in allowing corporates who have defaulted to get away by paying a small penalty or a small amount of the defaults. Now, I personally believe that something should have been done in that particular regard. Nothing of that type happened. Now, 15% cap, the other positive is a 15% cap on surcharge on long-term capital gains applicable to all capital assets. Now, it was earlier applicable only to listed securities. Now, it is applicable to virtually everybody. This is a big positive for investors who invest in startups. Presently, long-term capital gains surcharge on unlisted companies goes up to 37% to 42%, depending on various slabs. Because of this, it will now come down to 15%, starting March 2023. Concessional tax rate of 15% for domestic manufacturing companies commencing manufacturing by March 23 has been extended to March 2024. And the profit-linked tax exemption for eligible startups extended by 1 year. Now, this were the tax proposals. Now, what she has done to raise revenues for the exchequer, I think quite a few of them actually are things where she has plugged the loopholes. Let me state the first part as the bonus stripping and dividend stripping. People used to buy shares of companies which used to announce bonus issues, and they would sell it exports, maybe 15 days later, 30 days later, 45 days later, according to whatever I understand of the Income Tax Act. This was permitted, or this was rather allowed. It was not a contravention of the law. Similarly, for dividend stripping, a lot of people used to do the same thing, used to buy the units of mutual funds and possibly ex-dividend, they would possibly end up selling it. Now, she has plugged this loophole as far as tax avoidance goes through bonus stripping and dividend stripping. Listed stocks and mutual fund units have been also covered. Also, units of REITs, invites, and AIFs have been covered to stop dividend stripping. Earlier, this was not there as the part of the provisions. Now, there is no tax concession for Indian firms, especially multinationals like TCS, Infosys, big pharma companies, Tata Motors, Wipro. Now, bonus stripping, dividend stripping, I mentioned that has been plugged, and I'm also mentioning that no tax concessions now for Indian firms. The big companies, multinationals like TCS, Tata Motors, Infosys, Wipro, the pharma companies which have subsidiaries abroad. If they have 26% stake or more in the subsidiaries, they were getting dividend from that profitable subsidiary abroad. That dividends, they were paying tax at 15%. Now she has said nothing doing. You will have to pay tax at the normal corporate tax rate, which could be anything between 22 to 30%. So these two things have been taken care of as far as the tax provision goes. The next point is basically that the crypto tax. Now, there are various ways which people are talking about it. According to a rough estimate, more than 10 crore Indians are playing in cryptocurrencies. The question is, will the government make it legal? Official word has still not come on that. But she has stated that it's going to be a 1% TDS. That means you are going to be able to locate anything and everything. Also, the tax rate for cryptos is going to be as high as 30%. It is put in the company of speculative activities like horse racing, lottery, gambling, etc. No deduction will be allowed in respect of any expenditure or allowance or set-off of any loss while computing income from transfer of such virtual digital asset. The TDS at 1% will says yes. I would not like to argue with it. Possibly, I feel that could happen. Now, is that a positive for more money coming into the markets? Distinctly, the answer again, according to me, is yes. And if you don't agree with me, well, it's your view. This is my personal view. So this is one thing which can end up going in favor as far as the stock market goes. Now, let me come to the sectoral impact before I come to my view on the stock market. The sectoral impact, I would say, I would cover a few sectors in which there have been direct impact of the budget. First of all, I would like to touch is the defense sector. The defense capital budget, mind you, has been increased by 13%, 1-3. Sounds perfect. More important, the indigenous component has been increased to 68%. Which means that defense capital budget for domestic procurement has been increased by 30% year on year. It is certainly a positive for companies like Hindustan Aeronautics Limited, Bharat Electronics, Bharat Dynamics, and others. If you ask me, I think Bharat Electronics is the most favored stock in the stock market, but in terms of valuation, I think Hindustan Aeronautics looks quite attractive. I have already given the disclosures earlier. Second sector, I think, which should do well, which is otherwise doing well, and where there is thrust of the government, there are provisions in the budget, is the logistics space. 1.4 lakh crore for development of railway infrastructure, new generation Vande Bharat Express trains. 100 cargo terminals are to be developed over the next 3 years. 4 multimodal logistics parks to be awarded in FY23 to strengthen the logistics infrastructure. Another sector which not many have highlighted is the gaming sector. When we talk of gaming, we think of Delta Corp, we think of Nazara Technologies. What the government has done is animation, visual effects, gaming, and comic, which is AVGC task force, is to be set up. Adoption of central background digital currencies to spearhead digital inclusion in payments as well as entertainment sector, boosting esports and the gaming sector. Certainly, if implemented well, this could be a very, very, very big positive for the sector and for the companies in this sector, especially the listed entities, both of them otherwise being managed well at the moment. Now we come to the third sector, which has been the favorite sector of the stock market because they have been overpleased that the government has laid a lot of thrust on it. This was largely expected, and I'm referring to the infra space or the engineering space, the construction space, call it by whatever term. But here I have a reservation. Against the headline capex growth of 35% over last year's budgeted expenditure, the actual core infra growth is budgeted at just around 10%. Why do I say that? The gap is partly addressed by an accounting trick that brings in internal and extra budgetary resources, IBR funded road capex of NHAI, which is of 650 billion. Now the government has brought it to its own books and boosted the figure. While a larger share has been explained by loans to various states for capex, which is nearly 1 trillion, and incremental telecom capex, which is nearly 500 billion. Are this positive? Of course, they are positive. I'm talking of the numbers. Now, NHAI thing, which has already been funded, is brought into the government books. So what? As long as we are going to see capex going up, it's certainly a positive for the economy, ultimately for the employment, and ultimately for the well-being of the people of the country. The other space is railway capex. Railway capex is a bright spot with a budgeted growth of 14% over FY22 budgeted estimate. Road capex, mind you, is just rising 3% over FY22, but that reason I've already explained after NHAI thing. The budgeted spending on metro and rural, urban and UMBRO smart cities, unfortunately, is very low at 0.5%. The thing which attracts my attention from the stock market angle, from the budget angle, of course, I'll come to that in the next few minutes, is the Nal Se Jal and Swachh Bharat mission allocation, which have risen sharply at 32% in line with the scheme's strong progress over the last few years. Then the other space, which has become a favorite of the market and of the government, is the EV space, or you can also call it in general the automobile space. There has been a boost for infrastructure spending, which is good for CV OEMs like maybe a Tata Motors or Ashok Leyland. The battery swapping policy for EVs will benefit all existing EV players as well as new entrants, and especially those in charging infra and battery swapping network. The clean and sustainable mobility push in urban areas through public transport with EVs is certainly a big positive for adoption of electric buses. Names which come to light are Auto Corporation of Goa, Electra Green Tech. They're all in those electric buses part. So there are companies which will ultimately end up benefiting. I'm not nowhere saying the stock should be bought in a hurry, but these are companies which are doing well and which should end up doing further well as the government starts implementing what they have been liking and what they have advocated so far and what they have clearly spelled out in the budgetary document. Infrastructure, 32% increase in allocation for Jal Jeevan mission is certainly a positive for water management companies, and the 8% increase in allocation for shipping and 5% increase in allocation for Sagar Mala and ports is a positive for a leading port company like Irani ports. So these are some sectors which I have touched upon. Another sector which I have been liking, in fact, in one of my television shows in the first week of January 2022, I had clearly stated that this is my personal view, that I feel banks will outperform, or bank stocks will outperform the broader market in 2022. I had also mentioned that the IT stocks will end up disappointing investors in 2022. Not because the story is not good. In fact, India's IT story is super. Most of the companies are doing super business. But at P ratios, especially most of the mid-cap IT companies at 70 and 80 and 60 P ratios, how much more money you are going to make? Inevitably, IT stocks came down by nearly 10 to 12% in January 2022. IT index came down by 10%. So they will go back to that level, come down, go back to that level. One has to understand that IT companies cannot even improve their margins by 2% over a period of 3 years. So you are buying at the most expensive valuation where every investor on the street, every broker on the street, and the dogs of the brokers, the dogs of the investors, all are owning at least 2 to 3 IT stocks in their portfolio. Most overowned sector, doing very well, no doubt about it. But they will go on providing trading opportunities. At the peak prices, honestly, I don't see more than 10% being made in calendar 2022. That was my view. I personally hold at least 3 IT companies. I know I'm not going to make big money on that, but I'm quite comfortable holding on to them because the sector is doing well, those companies are doing well. But as far as bank stocks goes, we need to understand most of the books of most of the banks have been largely cleaned up. They are available now at a decent price to book value. Earlier, I used to question the book value because what is the question? What is the sense of having a book when most of the books are in bad shape? But now with most of them cleaned up, the price to book value of quite a few PSU banks look attractive. The private sector banks, of course, led by HDFC Bank and ICICI Bank and Axis and even an IndusInd and Kotak, they all look good in their own way. So I feel it is a time for bank stocks to move. They have started on a good note. They are outperforming the market in 2022, and I will not be surprised if this continues. People may argue that there could be problems as far as the financing of all these programs that the government has announced. Government will borrow more, bond yields will go up. Certainly, they will go up a little bit, not ruling it out. Bond prices will come down. Mark-to-market losses banks will have to take, especially public sector banks. But then the market possibly will take it in stride because let's understand one thing. Over the last 2 years, since COVID began, full marks to the managements of Indian corporates, they have reduced the debt. If you look at the debt in the balance sheet 2 years ago, and if you look at the debt now, most of the banks have most of the corporates have brought up the debt. Also, we need to understand that the capex cycle in India has started. Companies have started announcing expansions. They will go back to banks to borrow and to set up their projects to do the expansion. Now, at this point of time, the banks' lending will increase. Already, I think at least banks like a Federal Bank, if you see a Karur Vysya Bank, if you see, which otherwise not many discuss, or you see Kotak Bank, look at the credit growth in the December quarter. It's unbelievable. Because this type of credit growth, we have not seen banks delivering for at least the last 7 to 8 quarters. And if the capex cycle takes off, which I believe will possibly strengthen as we go ahead because of the budgetary provisions, because of the government's thrust on that, I think can only increase from here. And if interest rates go up, which can go up and which could go up at least by half percentage at least in 2022, I think it augurs well for the banks. Because banks are sitting on huge deposits and they will be able to improve their margins. People may argue they will increase their rates on bank deposits also. Maybe yes. But if the lending rate improves further or remains at least double-digit level, which they are showing signs of, then it is definitely going to be positive for banks at the end of it all. So I think despite the fact that bond yields may go up, I have reasons to believe that the overall banking sector should do well in 2022. Now we see the next thing is a fiscal deficit target. Now this is something which is a gray area if you ask me. I can speak on this in both ways. Number one, you can say that fiscal deficit target at 6.4%. I was speaking to my friend in Singapore last night and he was trying to say, kya hua, 3% fiscal deficit target hone ka tha. Ultimately, in 1 year, it's washed off. It's gone back to nearly 6.4%. Yes, 6.4% seems to be higher than estimates, which was around 5.7%. We have to understand that the economy is just coming out of COVID. We have to understand that whatever possible way the government had tried to support the economy. So something like a 3.5% fiscal deficit, which was there some years ago, which you are planning to have, suddenly going up to 6.4 is not something which looks good. But certain difficulties have to be accepted. What the government has done has to be accepted. So again, that 5.7 expectation, 6.4 seems to be on the higher side. Answer is yes. As a percentage of core revenue also, percentage of core revenue, mind you, it is budgeted at 75%, which is almost the same as FY22 and the highest since FY94. And yes, even higher than the FY10 post-Lehman crisis. Now, why did I say I can argue on both sides? I am saying I can argue on both sides for the simple reason that the budget has been so well scripted or well worded that I will say that fiscal deficit is 6.4% because divestment figure is taken only at 65,000 crores. And you very well know, sir, the 65,000 crores, so sala ek do divestment se hi ho jayega. I can also argue that the tax receipts seems very attainable, projected tax receipts. And there are reasons to believe it will be far, far, far exceeded. So this fiscal deficit, which has been projected, I think we could have a positive surprise next year. Certainly not ruled out. One more thing, let's not forget, and nobody has mentioned of it because it's in front of your eyes, but you don't look at it. There's something called GST. GST has become such a wonderful thing for the government that every month, 1,95,000 crores, then 1,10,000, now 1,42,000 crores. So this has become a compulsory cash cow type of thing for the government that every month they are going on earning. It's a different issue, and this is my personal view, that the GST revenues have gone up. People are saying, "Dekho, yaar, economy is rebounded well." Economy is definitely showing signs of improvement. The capex cycle is improving. But the GST collection is also thanks to the inflation impact. Prices across the board, across sectors, not only FMCG, virtually everything has gone up, and that is also contributing in a big way to the fiscal, to the GST revenues. Now let me come to my version of the stock market.
Stock market.
Pardon? Hello? The stock market and the budget. As I mentioned earlier, it was inflation, interest rate, liquidity getting sucked out, geopolitical problems, oil prices going up. As soon as oil price goes up, then everybody starts talking of $110 coming, $100 coming. When it is $80, nobody predicts that it's going to go up. When it starts going up, people talk more and more. Then the best of experts who came on the best of channels in the newspapers also, they said US is going to suck out liquidity again. Fed is doing the tapering process. Money will go back. Process of adjustment is on. That's what the best of experts said. What is adjustment? Money is going to get sucked out by the US Fed. Markets will correct, markets will contract because market knows about it. Some adjustment will happen, not to worry too much. But nobody told me, nobody told you how much the markets will. You had the Nifty just before the budget, you had the Nifty down by 7 to 8 percentage points. But you had at least 50% of the 500 top stocks, 20 to 50% lower than their highs. You had portfolios bleeding, whereas the Nifty was down only 8%. I'm talking bleeding was in the last 2-3 months. Look at the pharma stocks. Look at the specialty chemical stocks. Look at the way they have fallen from the peak levels. If you're owning those, they gave you super returns in 2020, early 2021, but they started correcting somewhere. Maybe pharma peaked out somewhere in September. Specialty chemicals peaked out somewhere in October or November. IT could have peaked out in January. We don't know. You will again say it's a rotational shift. It's not. It is a fact that the market somewhere has recognized that valuations in quite a few places, quite a few pockets had become extremely expensive. So my suggestion or my advice to you would be that have caution and don't go and buy expensive stocks. You will get carried away. You will think, "Arey yaar, 3,000 wala 2,500 ho gaya." But the point is, don't forget that even at 2,500, the stocks would be valued at 60, 70 times their potential earnings. Another warning which I would like to give you is that we have to understand, we have to accept that the markets, Indian markets, are relatively more expensive than most of the markets in the world. It's a different issue that we may end up being the fastest growing economy for some more time to come, certainly. We should feel happy about that. Yes, we could make money at the cost of some other countries, which are frontline countries as far as economies goes, but which are going downhill right now, and we could take advantage of that particular opportunity. But yet the fact is that the market has recognized all these things. Valuations in quite a few pockets had become very expensive and are still expensive in certain pockets. Also, be ready for huge bouts of volatility. Today also, I think people are feeling that the market has reacted well post-budget. But within 48 hours, today we were down nearly 1,000 points on the Sensex and nobody noticed it, nobody bothered about it. So क्या हुआ यार, budget खराब नहीं है market के लिए, budget अच्छा ही है market के लिए. The fact is, such type of volatility can happen. Do you lose your sleep over that? You may, if you cannot possibly tolerate volatility. But this is something which somewhere investors will have to take it in the stride that, okay, after a year, I will be higher than where I am, and I should not bother too much about short-term falls here and there. Factors that we will need to keep in mind are ultimately the global markets. Also, we will have to keep our fingers crossed and look at God and go on praying to him that let's hope we don't have a fresh variant of COVID. Another thing which we will have to look at are the bond yields in India. While I protected the fiscal deficit part by saying that the tax receipts with the government would end up earning in 2022-23 would be much higher than estimates. Divestment figure would be much higher than estimates. So this time there are no complaints ke sala government kuch bhi bolta hai. It is not that way. Most of the figures look attainable, and therefore we may not have a negative surplus as far as fiscal deficit goes. Government borrowings hopefully may remain in check thanks to the huge collections which they're getting on the tax receipts front, including the GST. But at the end of it all, you will have to watch the bond yields in India and what it can do to the Indian currency. Another factor which I feel we should also look at is oil. If we have some sort of gadbads between Ukraine and Russia or whatever, or ultimately whatever OPEC decides to take a call, I think they will take a call sooner or later, right, at the moment, but we will have to watch oil. There are decent research houses predicting that we will ultimately see oil going beyond 100 and possibly to $110 over the next 2-3 months. And that is certainly not good news for an economy like India. Personally, I remain bullish. I have been an eternal bull all my life. I have seen bouts of volatility. I have seen the crash of 2008. I have seen quite a few sharp falls in the market. I have seen the market touching the lower circuit when the government lost the elections. All those things I have seen. I have also seen upper circuits in the market, and I have survived. And you will survive too. Just learn to take volatility in your stride. But from the highs with the markets made, 18,500 or whatever level it was, as I mentioned earlier, today we are just 7% away or 6% below that. But yet quite a few stocks are 20-30% lower than the highs. It again means that you will need to realign your portfolio to the present times. Somewhere you have to accept the fact that my portfolio could be comprising of stocks, I don't want to name any, which are extremely expensive in terms of valuations. The reputation of the company does not matter. What matters to you is from the present level, will I make this much return or will I fall this much? If you feel the return which you make from the present level is going to be lower than the potential fall in the share price of the stock, you should understand that that's a little bit over expensive stock which is there lying in your portfolio. Now, the budget has laid stress on certain sectors. Most of them were expected. I would say that sectors like industrial, capital expansion, capital expenditure, the core sector, concentration is on that. There is something called Jal Vikas, which I was saying that as the water management sector. There is the railways, logistics, defense, waste management, EVs, solar panels, data centers, food processing, green energy. These are the sectors on which there has been a lot of thrust. Most of the sectors are sectors which were already in favor. A lot of big things were being spoken about by the ministries concerned. Prime Minister himself was saying that I want this, I want that, I want this, and they are working towards it. So I would not give any price for people guessing that this type of things will happen. The quantum differs. The quantum differs. So as far as water management goes, suppose they are talking of nearly 32% increase. I think you should look at some water management companies, like for example, a company like Siemens, a company like Thermax, a company like Indian Hume Pipe, a company like Iron Exchange. All I think should do well as more and more money goes into this sector. And let's not forget, water ultimately is a theme which will not be a theme for India, but for the world. So second is the industrial capex thing. Most of the companies are well-managed companies. Most of the leading companies, you talk of Grindwell Norton, you talk of KSB, you talk of SKF, you talk of ABB, you talk of Siemens, you talk of Larsen & Toubro, you talk of Thermax, you talk of Foseco, Timken, Shanti Gears. All these companies are good quality, solid companies. Look at the stocks themselves. If you feel they are attractive enough, if nothing else you understand, try to possibly see the 52-week high. If they're corrected enough, you can go and buy into them, because I believe that the fortune of this industry, which is on the rise, I think should gather a lot of pace with the budgetary proposals which have been presented by the finance minister, with a clear thrust on industrial capital expenditure. And also not forget one thing. I mentioned about IT earlier. It's very difficult for them to improve margins by 1 or 1.5% over a period of 2-3 years. It's the other way around in capital. When the capex cycle turns, the numbers increase very sharply, very fast, very soon. And before the market can understand, you suddenly get very pleased with the numbers, and then the stock price suddenly starts going up. Quite a few of them would have been recognized, but the market would have gone up. But it doesn't mean that you should not be looking at this sector with a very positive intent and have it in your portfolio. That's my personal advice. As far as EVs goes, I think companies like Tata Motors have had a head start. Even an Ashok Leyland could do well, but the ancillary companies also, quite a few of them, you should be looking up to and possibly looking at them, because this is a sector which I feel should gain a lot of traction going ahead. Electric buses, I already mentioned names like an Electra, Green Tech, and Auto Corporation of Goa. Then, if you ask me outside this sector, what looks very attractive in the market, I would say what was specialty chemicals to you in 2020, when China aggression a little bit happened. We had problems with China. The world started looking at China negatively because of the COVID variant in 2020, and specialty chemical segment took off in a hurry. Most of the stocks in this space, irrespective of which company, I think just mention that this is in specialty chemicals, and markets started giving it a very high discounting. Stocks went up by 50, 100, 200, 300%, some of them. The space which I would possibly not put it in the same bracket, but which I think should do very well for India as a country, is textiles. I think textile stocks have done super over the last few months. This unfortunately still, or rather fortunately still, is an under-owned sector. You talk to 10 friends of yours and find out how many textile stocks they own. And they will all look at you and say, "Nahi yaar, बढ़ गया, लेकिन मेरे पास कुछ है नहीं, कुछ लेने लायक है क्या?" And I think there are quite a few good names in that. If the stock prices have gone up, I have reasons to believe that these companies are doing well and should do well, at least for the next 1 to 3 years. And they could be in a different orbit, some of them, maybe 1 to 3 years later. The question is, should I buy now? Should I wait for a correction? Please take your own call. Discretion is yours. Use your discretion. Disclosure is mine, and I personally like it and I own it. Names like a Lakshmi Machine Works in the textile machinery segment. Super, super, super company. A leader in textiles, Vardhaman Textiles. Or do you want to buy KPR Mills, Sangam India, a Nitin Spinners, Indorama Synthetics, and Ambika Cotton. It is your call. But I personally believe if I had a person who's casually asking me, should I buy textiles, I would say the answer is a certain yes. So this could be a segment which could continue to, or we should attract more and more interest, is my personal view, and should do very well for India as an economy. Another sector which I feel is going unnoticed for quite a long time is the paper sector, paper mills. The stocks have just not attracted anybody's attention, and they look relatively cheap to me in the market. So I would say that I would like to end my discussion stating that India is a great market. India should attract money going ahead, again from the same foreign institutional investors who would possibly be selling because they have to somewhere think of the tapering part and a hike in interest rates coming in the US. Will the US hike rates every month starting March, which people are saying? My answer is, if you ask me, I think it's all humbug, it's all bullshit. I personally believe it will be maximum 1 or 2 or 3 at most rate hikes which will come from the US. This is my personal view. If the market starts discounting more rate hikes, it will be a pleasant surprise for the market. But somewhere we all know that the world is not a very easy place right now to be in. It's a dirty place right now. There are clouds over the horizon. So I don't think till the time these clouds go away, it's not going to be an easy place to invest money in the market. As I always say, equity is the best place to invest your money. It is one of the few assets which is going to fight inflation, which is a dirty factor right now. But be ready to face volatility. The best time for the bulls is behind us. And it's not going to be an easy time for bears also. As I mentioned earlier, if and when we fall, even by a 5% or 10%, it could impact your portfolio much more because some of those expensive stocks could fall much more. But on the whole, I think the budget has made Indian equity markets on a good wicket. We remain on a good wicket. And if you ask me, despite whatever correction comes, 12 months, 18 months later, will we be higher from where we are? My answer would be yes. But from the level which we were at 18,600, which I wanted to mention earlier, but I kept it for my last remark. If somebody tells me that we will be 10% higher than 18,600 by December 2022 in the next 12 months, I would like to ask him, why are you telling me that? I don't see possibly that happening. We could be in a range in which stock pickers will do well. And whenever anybody asks me a question, market ka kya lagta hai, index ka kya lagta hai, including my friends in the media, I tell them, forget the index. Look at your stocks when they come to the levels. Just go ahead and buy them. And the finance minister through this budget has clearly indicated the favored sectors. Some of the sectors like solar energy panels, which I mentioned, or a data center where Irani is going big over there. Solar panels, we have some names like SW Solar and all. There are not too many options, but the options are there are plenty in the industrial capex story, which I think has taken off in India. There are options in plenty as far as water management goes, waste management goes. There are options in plenty in the food processing sector. There are options in plenty in the textile sector, which I personally like. Budget has got nothing to do with that. So I would say that go and buy your individual stocks. Don't fret, don't fume. Whether you will come to a 16,500 or 16,000 and go back to 19,000, forget it. Don't bother about it, because life is meant to live comfortably without too much thoughts disturbing you. Just wait for the opportunity. If you're in a hurry to buy, then don't regret if the stock's correct by 10-15% from the levels at which you buy. But if you like that company, wait for the right price to come. Maybe the present price also could be a right price depending on what company you want to buy in. So this is an opportunity for stock pickers. I personally believe 2022, and the budget has done nothing wrong for the stock market. So if the market's correct, I don't think anybody, not even the biggest critic of the finance minister of the government, will say that the markets fell because of the budget. That's not happened. So the best thing of the budget was it's behind us without causing any harm and giving us a better direction. Only problem is they never touch the consumption theme, and they never took care of, unfortunately, some of my brothers and sisters who have suffered a lot since the outbreak of COVID in 2020. I think the finance minister could have done a little bit more for them. Thank you very much. Thank you again for the opportunity.
So there is one interesting question that has come up, and it was, since it was during when Jimeet bhai was speaking, I would like to take this question with him. Is privatization the way to boost economy, urban, rural? And what if there are malpractices, as government would not have as much control as before? And what about employees losing their jobs and social security, its effect on the share stock markets? So this is an interesting question, Jimeet bhai, if you can address it.
I think, in my view, privatization is a great way of boosting the economy. In fact, as Mr. Modi has said very often, that the government has no business of being in business, and our view is the same. In fact, that the private sector ends up doing things a lot far more efficiently than the government. Excesses capital efficiency, allocation of capital is far more efficient. In fact, they would end up creating far more jobs than just the government. So bureaucracy always slows the wheel down. So obviously there will be certain processes where inefficient employees may end up losing their jobs or end up having some social security issues. But I don't think that probably will be a function of the marketplace, where people who are actually genuinely deserving, adding value to the economy, to the system, will end up getting rewarded, and those who are not typically contributing will get weeded out. So in fact, I think the privatization of Air India, and transferring that to Tata is one of the best decisions that the government of India has taken actually in the past few years. And that will actually give a big boost to both the government finances, which were getting drained because of Air India, that will get stopped. And as an airline also, we expect Tata to do a much better job than the government itself, because of its deep understanding of business and associated activities around it. So our sense is that it's a great way. I don't see there is any downside of the whole entire privatization boost.
Thank you, Jimeet. Mehraboon sir, the next question is addressed to you. People want your views on the entertainment sector, especially on Z, if you could share.
It's not very fair to speak on an individual company like that, but I think Z is sitting on a good wicket if all the things get sorted out well. I think it's very, very cheap. It was always cheap. Now, there are question marks on corporate governance. If all those things are taken care of, what Sony brings to the table, at least I don't know. I don't think anybody knows, but we're all assuming Sony and Z will work together. It will become the biggest. It will have a great bouquet of channels. It will have a lovely library. Answer is true. At this level, the stock honestly looks very cheap. But in the same breath, I wish to state that how many media companies have given money to investors? Relatively, I think the sector has always underperformed. Even Sun TV looks very cheap to me in terms of valuation. But this sector on the whole, I think, should attract a lot of attention. Even Mr. Ambani is planning to enter this sector, or possibly put more money in this sector. So somewhere I could be underestimating the strength of this sector going ahead. So at the valuations at which they are, I would say nothing much to lose. Z looks certainly the best horse in the stable of the media sector. The entertainment sector, if you ask me, the gaming sector, a company like a Delta Corp with clear disclosures in place, I think looks very hot to me. So Z at the present level, not too much of downside if things work out well. If Sony brings a lot of things on the table, I think this stock could give super returns over a period of time, but I would not be able to recommend it right now because still there are a lot of gray areas which are yet to be clear.
I would request all the participants to either ask questions pertaining to a sector or economy or something, because we would not like to entertain questions particularly on companies. There are a lot of questions coming on views on personal companies, but I think we should avoid that. So I'm not taking them further. Sir, Jimeet ji, there was one question which Mehraboon sir to an extent answered, but again, the participant was requesting your views on the crude per se. And right now, as Mehraboon sir mentioned, there is a expectation or media speculation that the crude might move on from the current levels to more than 100 or 110. So how do you see that impacting the economy as such?
So I think crude is very, very well documented that crude prices going up is never been good for India because we've always been a net importer. So I think that is always the case. And I frankly don't know what's going to happen to crude prices. I'm not an expert on crude, so and I don't think anybody in the is an expert really on crude. But our limited sense is that typically it's a very seasonal commodity in the sense that we end up seeing a big seasonality effect for crude, where when there is winter in North America, where production is typically lower, we end up seeing supply side issues which typically get eased out after March, when the northern continent goes into summer and when supply side issues get eased out. So we've typically seen that kind of seasonality in crude, and that could happen. So, but I think specifically, I don't think that we're in a position to comment on what will happen to crude prices really.
Mehraboon sir, the next question is for you. If you could share some views on the FMCG sector.
I think not very happy with the volume growth that most of them are shown. Most of them are great companies. The big positive about the stocks are that most of them are quoting much below their peak prices, including a stock like a Hindustan Lever or a Nestle, are quoting at 10-15% lower. Is it immune to everything in this country? Answer is yes, because ultimately people have to shave, people have to brush their teeth, all this type of things. If I start discussing it, I think I'm not very wrong. But the question is, am I going to make money in this space? I don't see this budget having done anything as far as direct impact of putting money in the pockets of people. I mentioned about senior citizens because I become very emotional when I talk about it. I have not become a senior citizen. I'm at least 5-6 years away from that. But I know a lot of people who are suffering. I also know that a lot of people have lost their jobs. Nothing has been done for them. Do you expect them to continue to consume the same way? You are sadly mistaken if you think that way. So consumption, I don't think is going to take off in a hurry. Also, the rural economy is not the best of shape at this moment. It is nice to say that all these measures which I'm doing for the infrastructure and capital goods space ultimately will augur well for India's economy, will create jobs. Who is saying no? Is it going to happen next month? Is it going to happen the month after? You also know the managements of superly managed companies like Nestle and Hindustan Lever coming out of the open and saying that rural economy is not picking up. Consumption is not picking up. Volume growth is in the single digit of 4, 5, 6, 7%. So this is not the best of news. But the point is, the market is more intelligent than all of us. The stock prices of all the stocks have corrected well enough. The downside from here could be limited. So if you want to play the bet, like what my friend Jimeet was saying, if the markets actually fall sharply from here, at least momentarily, well, the stocks could become safe havens for people. So if you are not very comfortable in buying the relatively expensive companies or stocks which will do very well as a company over a period of time, but you feel कि नहीं यार बहुत महंगे अभी नहीं लेना है, then you can hide yourself in some of these FMCG names, and there is a selection is plenty. You can buy a Marico, you can buy a Lever, you can buy a Nestle, you can buy the completely neglected Colgate, which is neglected for some other reasons, not for the performance of the company. So there are a whole lot of Dabur is good. Everything is good. But the point is, am I going to make big money in this? My answer would be a reserved no in this, at least not over the next 1-2 quarters.
Another question, sir, is will power funding NBFCs do good in the year 22-23? Particularly your view on the NPAs of these kind of companies, particularly the thermal sector.
Which sector are you talking about?
Power funding NBFCs.
No, I don't like the sector at all, power funding. Sorry, I don't like that.
Okay.
You're talking about PFC and all, na?
Yes.
No, I don't like them, unfortunately.
There is one question. What about the cigarette industry, especially the languishing stock, which has not seen traction for a long time?
I have been stating this for quite some time. If this question is addressed to me, my answer is very simple, that I have been stating that ITC stock, I don't see it going up in a hurry. ITC will be unstoppable when the demerger will happen. But you cannot go on investing my money, the shareholders' money, into various new businesses all the time. Some of these businesses are not yielding profits to you, now to the shareholders. So in the name of the cigarette industry, if you are diversifying yourself in 10 or 12, 13, 14 different businesses, some of them are not doing well. No problem. But the point is, somewhere I know that the time has come for me to have the demerged entities and get my shares on them. Now, will that happen in a hurry? I don't see that happening. We are ultimately in a country like India where all this type of things take a whole lot of time. Also, we have to understand there's a boardroom of ITC. There are shareholders like British American Tobacco also sitting there, a whole lot of other stakeholders. So this type of thing, ultimately one fine day will happen. And when that happens, the stock will be unstoppable. But I don't see it happening in a hurry. So I will not be surprised if ITC languishes at the same rate for a much longer time, which somewhere I think the investors have given up on the stock. So if somebody is holding it as a good dividend yield stock, it's a great company. Businesses, some of the businesses are doing very well. As a company, it will do well. Nothing to do with cigarette and the taxes of the government, because of the taxes are increased by the government, but they are not for some time to come. But even if they increase, I always say it's a positive for tobacco companies, because taxes are increased by a particular paisa. They round it off to the nearest rupee and increase the prices. So ultimately, it's beneficial for cigarette companies that taxes go up. It's not gone up. Business should remain good. The stock should remain undervalued. A lot of people like you and me will come and speak to the media and say, "Sabse sasta FMCG stock hai," but it may remain cheap in terms of valuation for a much longer period than what we would have thought. So last 2-3 years has become a very boring stock. Unfortunately, despite it being cheap, I still believe it is cheap. And one fine day it will show its true colors, but it may not happen in a hurry.
So I would take last question. Interesting one. How does the digital currency affect our economy? Do you think blockchain technology will see light of the day in our country? Should I repeat the question, Mehraboon sir?
You're asking me? Okay.
Yes, sir.
It's too early days to say, but you can see the body language of the finance minister, even the prime minister in this particular aspect. So I think ultimately whatever will happen will be positive, and it will be more positive for certain sectors. I mentioned sectors like an esports and other things, the gaming sector. It's going to be very, very, very big positive, because quite a few of them will be encouraged to spread their wings a little bit more. I can't spell out too many things on that. Ultimately, the RBI will come up with a digital currency maybe later in the year. There are not too many things spelled out, but the way it is being brought across in that budget speech and the way the Prime Minister has spoken about it, there are reasons to keep your fingers crossed and be positive about it.